This, ladies and gentlemen, is the 10th year that the current management team at Coforge has been at the helm. 9 years back, what was a $400 million revenue organization when we took over is poised to close the current year having grown almost 7 times in just 10 years. As you listen to our quarter one commentary and the very robust growth and margin expansion we see ahead of us in this year, we hope you will recognize that the execution intensity and the commitment that has got us here over the last 9 years is not just undimmed, but it is actually getting stronger. Over the last 9 years, we have delivered a revenue CAGR of 21.9%. Over the same last 9 years, we have delivered an EBIT CAGR of 24.6%. And over the same last 9 years, we have delivered a PAT CAGR of 24.1%. And it is the future which in the short term looks set to mark Coforge out as the firm which truly brought the promise of enterprise AI to life. Our pipeline of large deals in Q2 and beyond has never been stronger than it is today. In Q2 itself, the quarter we are in, 1 month has elapsed, we believe that we are likely to sign large deals in numbers that will be very close to what we signed in the full year just 3 years back. You will recall in quarter one, we had indicated that we were set for a flat quarter because we were culling elements of our India government and data center business to ensure that we deliver on our promise to expand reported FY27 EBIT to 15.5% on a consolidated basis and reported FY27 EBITDA to around 20.5% for the year. We are pleased to report that not only have we exceeded the full year EBIT margin guidance target in quarter one itself, but that we have also grown 1.1% CC sequentially. Excluding the impact of the businesses that we culled in quarter one, we have grown almost 5.2% CC in sequential terms in quarter one. Our growth in quarter two and beyond is likely to be very robust, and our margins, having reached this threshold already, will sustain at a minimum and likely expand further. In quarter one, 86% of our business came from AI-led engineering, data, and cloud services. Equally importantly, in Q1, the Encora acquisition was consummated using the proven Coforge integration playbook, which is uniquely our own. We are ahead of the cost synergy plans we had shared as part of the acquisition case, and this is reflected in the fact that our consolidated reported EBIT margin in quarter one is already at 16%, while our consolidated EBIT plan for FY27 that we had shared with you was 15.5%. So at this time, we know that Encora will create exceptional business value and synergy in line with what Signity, what SLK Global, and what Incessant did. Excluding one-time exceptional costs, EPS for the quarter was rupees 13.30 compared to rupees 13.80 in the previous quarter. As we guided earlier, we remain on track to be EPS accretive in FY27 following this acquisition. We believe that the AI-driven disruption will create select yet outsized winners. The new AI-driven world demands that our industry pivot itself from operating on a scale of people to a scale of intelligence. The AI conversation has changed. A year ago, enterprises were asking, how do we deploy AI? Today, they are asking, how do we operationalize it? How do we govern it? How do we scale it? How do we turn it into measurable business outcomes? This shift, which is creating the next wave of opportunity for our industry, is what we at Coforge call the shift towards enterprise autonomy. The differentiator will be applied AI. AI grounded in the business context, AI grounded in process, AI grounded in policy and risk. It will come from operationalizing intelligence across the enterprise. It will come in the form of AI that works inside real, complex enterprise environments. That is where value is moving, and that is where we are focused. This is why we built Coforge Neuron. Neuron is our AI operationalization platform. Its purpose is simple: to help enterprises move from AI pilots to AI operations. It brings together enterprise knowledge, decisions, workflows, governance, agents, and execution, so AI can operate at enterprise scale. Today, Coforge has more than 11,000 data and AI practitioners, 8 AI platforms, 22 AI assets, and over 100 reusable AI agents and accelerators. During fiscal year 26, we invested approximately $58 million in AI innovation. Furthermore, approximately 30% of active engagements, already leverage AI within delivery workflows. Finally, in terms of evolution of the delivery model, technology alone, we believe, is not enough. The delivery model must evolve as well. And that is why we have combined Neuron with forward deployed engineers, with mod squads, which are hybrid agent human pods, and with reusable AI assets. The traditional model was built around effort. The emerging model is built around outcomes. Our advantage is applying AI inside complex industries where domain knowledge, execution discipline, governance, and measurable outcomes matter most. We believe the next wave of enterprise value creation will not come from deploying more AI tools. It will come from operationalizing intelligence across the enterprise, embedding AI into decisions, workflows, and operating models, and helping organizations move from AI adoption to the term I started off this conversation with, enterprise autonomy. That is a journey Coforge is enabling through Neuron. Consolidated revenue for the quarter stood at $592.2 million. I want you to recognize that these figures include only 2 months of contribution from Encora, revenue starting the 1st of May and not the 24th of April. Revenue excluding Encora grew 1.2% sequentially in CC terms. And if, as I had noted earlier, if we take out the impact of the government and the data center businesses that we've culled in the quarter, the rest of our business grew 5.2% CC sequentially in quarter one. Our consolidated revenue on a year-on-year basis in dollar terms has grown 33.3%. Our consolidated revenue, again, on a quarter-on-quarter basis, dollar terms, has grown 21.1%. On an organic constant currency basis, banking financial services grew 2.9% sequentially and now contributes 24.7% of consolidated revenues. Insurance grew 4.6% sequentially and contributes 13.6%. Travel, transportation, hospitality grew 1.7% and contributes 21.3% overall. And healthcare high-tech grew a very rapid 11.6% sequentially and contributes 17.3% to our revenues. And others, now at 17.1% of revenue, declined 8% following the planned portfolio exits that we had shared with you. From a geographic perspective, organic growth was led by Europe and the Americas, which grew 8.4% and 3.5% sequentially in CC terms. Rest of the world segment contracted 22%, reflecting the impact of the portfolio exits across India government and the data center business. AI-led engineering, data and cloud, which is the strategic core of the combined organization, together contributed 86% of consolidated revenue during the quarter. AI-led engineering remained our largest revenue contributor at 50%, followed by data services at 21% and cloud at 15%. In terms of client mix, Coforge now has 1 client with revenue greater than $100 million, 3 clients with revenue between $50 to $100 million, 14 clients with revenue between $20 million and $50 million, and 29 clients with revenues between $10 million and $20 million. Our top 5 clients contributed 18% of Q1 revenue, and the contribution from our top 10 clients stood at 26.1%. Order intake during the quarter, we signed 4 large deals. As I noted in my earlier commentary, in quarter 2, we expect to sign more deals than we possibly ever have in terms of numbers in our history. Total order intake during the quarter stood at $691 million. Our next 12-month executable order book expanded to an all-time high of $2.23 billion. compared with US dollar 1.55 billion a year ago. That's an increase of 44.2% year on year. And that in turn provides strong visibility in line with my commentary for the year ahead. Total headcount at the end of quarter one stood at 46,228, reflecting a net addition of 10,451 employees during the quarter. This includes 9,256 colleagues from Encora who became part of Coforge following the acquisition. Utilization remained healthy at 82.5%, and we are holding it there because we see significant growth ahead. While the last 12-month attrition declined further to 10.4%, remaining amongst the lowest across the industry.
Across our client base, AI-native operating models are moving from ambition to production, with AI-led conversations converting into large, multi-year engagements. For a leading global financial institution, we are building its AI platform and agent ecosystem across the SDLC landscape, with the potential to deliver more than 50% productivity gains across their business units. For a leading wealth and asset management platform, our AI-native advisor experience desktop, powered by over 20 specialized AI agents, is delivering 30% plus advisor productivity gains. For a large specialty insurance provider, Code Insight AI was leveraged as part of a modernization program to migrate to Azure, reducing technical debt by 92%, delivering 99.93% field level accuracy and 65% productivity improvements. For a leading European client, we secured a 5-year, 230 million plus AI-led transformation program using low-code and no-code platforms. AI-powered automation and AI-infused SDLC to reduce their manual effort and improve productivity at scale.
Q1 marks a strong start to FY27, with the combined organization delivering results ahead of the operational and profitability objectives articulated in the beginning of the financial year. Revenue up 49% Y-on-Y, EBIT 101%, reflecting year-on-year margin expansion of 414 bips. PBT, profit before tax, up 92% Y-on-Y, an expansion of 284 BPS year-on-year, and PAT up 110% Y-on-Y, again reflecting 271 bips improvement in the margin. Q1 FY27 reported revenue stood at $592.2 million, including $100.7 million that came from Encora for 2 months. Consolidated EBIT margin came in at 16%. Organic EBIT margin was 16.7%. Within its first quarter as a part of Coforge, Encora delivered EBITDA margin of 20.3% and EBIT margin of 19.1%, reflecting a rapid expansion of the integration playbook and realization of SG&A and operational synergies. The combined org is now at 6.6% for Q1 FY27 from a G&A standpoint. This represents a reduction of 40% in Encora G&A. This is further going to improve in Q2 as a result of full quarter impact of actions taken in the current quarter. The hedge losses incurred during the current quarter amounted to $10 million. From fourth quarter onwards, we anticipate a positive impact of $10 million in our earnings as the hedge losses will be eliminated because of no open book beyond Q3 from our perspective. Exceptional expenses and acquisition-related expenses were recognized to the extent of $6.5 million in the current quarter, and $5.4 million were in Q4. We had guided for acquisition and integrated relation expenses of $15 million at the time of acquisition, and we are going to remain well within that budget. We expect marginal integration cost in Q2 and then nothing from Q3 onwards. Based on the progress achieved to date, we remain confident of not only delivering but surpassing the 15.5% consolidated EBIT margin guidance shared in last earnings call for FY27. Moving to cash flows, the combined organization generated a free cash flow of $52.9 million in quarter one, representing a FCF to PAT conversion of 95.3%. compared to negative 56.5% in Q1 same time last year. We remain confident of meeting the free cash flow to PAT guidance of 100% for FY27. On term loan, you would all recall that for Encora acquisition, we had taken a term loan of $550 million. The loan has a 3-year tenure and carries post-tax interest cost of 2.99% per annum. we'll be paying almost $59 million in financial year 27, $209 million in financial year 28, and $258 million in FY29.
Fiscal year 27 is shaping up to be an exceptional growth year for Coforge, despite the significant AI-driven flux. Not only do we expect to set the benchmark on revenue growth, but we also expect to emerge as one of the highest margin mid-caps across our industry in this year itself. The exceptional AI-led engineering, data, and cloud services capability core, which contributes to 86% of our revenues now, is what is helping us realize simultaneous and exceptional growth across both the revenue and margin expansion axis. With 8 AI platforms, 22 AI assets, more than 100 reusable AI agents and accelerators, $58 million invested in AI innovation behind us, we shall continue to center ourselves strongly on using AI to drive enterprise autonomy. As we had shared last time, for Coforge, the demand tailwind in the current environment is structural and pure. We recognize that AI-generated code is cheap to build, but we also realize that it is expensive to maintain, to secure, and to govern. We realize that agentic AI will create a massive managed services layer, managing which will create a recurring high-margin revenue streams, but only for firms that can seize it. Every AI advancement accelerates our growth. We are positioned for the near-term legacy modernization surge. We are positioned for the medium-term agentic deployment wave. And finally, we are positioned for the long-term expansion of the global technology market. The outlook for fiscal year 27 that we had shared last quarter remains unchanged. We are confident of achieving an EBITDA margin of 20.5 to 21% on a consolidated basis. EBIT margins are expected to be in the range of 16.5 to 17% on a standalone basis and 15.5% or maybe higher on a consolidated basis for the firm. Free cash flow to PAT for this year will be more than 100%.
How has the Encora acquisition impacted the company's financial metrics, including order intake, net working capital, goodwill, intangibles, amortization, G&A costs, and segment margins? And what is the strategy and timeline for its integration and revenue growth?
So the $691 million, Sulabh, does not include the order intake from the Encora portfolio. That's only the organic piece that has come from what used to be standalone Coforge. As far as the framework agreement and the likely further incremental work that we are likely to get, they are still not included in the order intake. That will continue to come and sit on top of the order intake that we've already announced.
So the absolute increase is because of consolidation of Encora, but the number of days have actually come down. It is only the goodwill that has reduced by $600 million. The intangibles, the amortization impact was roughly $4 million per annum, and we have kept it at the same level. So the intangible on account of customer relationship is close to 30% of the valuation. The G&A has actually come down as a percentage of revenue. The absolute number has gone up. If you look at Coforge standalone G&A last quarter was 6.7, and I had mentioned in my December call when we announced the acquisition that Encora G&A was at 10%. The combined G&A in the current quarter stands at 6.6%. So which means that there is a 40% cost out that has already been done on the Encora G&A, and this will further come down as a percentage of revenue. So one, there is reduction in the India government business. And there is also reduction in the data center business, which was sitting in the rest of the world. So which was coming at a much higher margin. So that's why you see that the overall margin over there has remained flat. And plus the current quarter also includes the consolidation that has happened from Encora coming in. So that's why the overall numbers are looking flattish, but you will see now the rest of the world margins will start expanding from here on.
If you look at all three, data, cloud, and AI-led engineering, that number has gone up significantly. You'll see that AI-led engineering has popped up by 5%, and cloud percentage contribution has gone up down by about 2.7, 2.8%. Encora has mainly engineering and not cloud revenues. Therefore, when the two firms merge, naturally there would have been a small bump on the engineering piece on a percentage contribution basis. As I said at the outset again, in response to this question, engineering revenues as a percentage were likely to go up because Encora had negligible cloud-related revenues. And just for the record, cloud for us sequentially has grown 4% QOQ, right? Encora may have influenced the percentage contribution, but the business continues to do extremely well. I think by Q3, which is just a quarter away, we see some very large opportunities in what used to be the Encora client portfolios. Today, one of our top 10 clients of the merged entity is a client that has come in from the Encora portfolio, and that's a firm. That's a relationship that we expect to scale up almost immediately and very rapidly. And we do think if things go well, there is a path to making it a $50 million plus account over the next 12 to 18 months. There are two other accounts in account list 11 to 20 of Coforge that have come in from the Encora portfolio. One, we said the AI-led engineering capability and the combined engineering data cloud core will be on a composite basis, a great differentiator. The second thing we had said was the acquisition will give us a new vertical high tech. You looked at our height and will also nearly double our healthcare business. And third, of course, something that we've always talked about, taking clients and amping them up. We effectively operationally run Encora for 3 months. We believe that asset has already started making an impact. The point that Saurabh made earlier was the synergies, the cost synergies have been exceptional, 40%. You look at our consolidated EBIT, that's 16%. I think we know now that this is going to be a defining acquisition and a very successful one for us. Devesh, I won't have that number, but as Saurabh had pointed out, since we've taken only 2 months of revenue off Encora starting the 1st of May, the revenue was, if I remember right, $100.2 million. At this point in time, all I can tell you is the order intake was robust. And as I'd indicated with some of the large accounts that they have, the pipeline also is robust. On margins, anyway, the organizations are indistinguishable given the very aggressive cost out we've done. So Q3 onwards, revenue growth, they will be indistinguishable, recognizing that the Coforge threshold that we've already established is that at a minimum, it will be very robust growth.
What is the status and expected revenue contribution of recently closed large deals, including the $158 million and $230 million? And what is the company's overall growth outlook and guidance for the current and upcoming quarters?
So look, we think Q2 is going to be a robust growth quarter, and for everything that we needed for that quarter to come through is already in place. We've already closed some of these large deals in the first month of the quarter, but most of these will really start impacting Q3 onwards. Even in Q1, we grew 5.2% CC sequentially.
It was a Q2 deal, so it's not integrated.
Regarding the initial deal announced, yes, the ramp up has been completed. We did the transition from the incumbent in a record time in less than 4 months, and we're now in north of 300 plus FTEs focused on that account across 15 to 20 teams. On the second deal that we announced, the $230 million plus deal, that the ramp up has already initiated on that, and that is expected to add an additional 20 to 30 teams. And I'll also note that that second deal is a complete digital modernization program spanning multi-years.
The second question around 5% organic QOQ, no, we have not provided any hard QOQ revenue guidance. All we've said is we expect the quarters starting Q2 to reflect robust growth going forward.
How is the company monetizing its AI platforms and assets like Neuron? What is the overall enterprise adoption trend for AI? How does the company differentiate itself in the rapidly evolving AI space? And what are the market sentiments regarding specific LLM models, such as those from China?
As far as Neuron is concerned, and Neuron in some ways is the operating system, it's not a platform. Neuron is further led by the 8 AI platforms that we have and the 22 AI assets that we talked about. As I had referenced, 30% of the active projects, delivery projects, real projects, are being driven through our AI assets or are infused with the AI assets. We can't call out a number which is AI only or AI standalone. The number that we have shared is that 86% of the revenue of the firm in Q1 has come from AI-led engineering, cloud, or data services. Given the rate of change and the speed of change that's going on, I think and most enterprises are not tying themselves to a specific model. So we're at a stage right now where, from a Coforge perspective, we have come up with service offerings on a very quick basis when it comes to token ops to manage token economics. We are at a stage where, as Coforge, we have been working with our partners like Zscaler to come up with service offerings that have already got monetized around partnering on the Guardian AI platform and come up with managed services-based constructs around Mythos-related security vulnerability assessment. So the smart enterprises, at this point in time, the one key learning that we see all of them having taken is that they're not tying their wagon to any particular star, to any particular LLM model provider, or to just one or two cloud providers. We are seeing enterprises increasingly focused on what they're calling enterprise sovereign AI or enterprise open intelligence, and increasingly trying to divorce that data processing and moving it in-house with the associated security and governance issues that are going on. At this point in time, we are not working with enterprise clients in North America who are leveraging China-based models actively within their realm.
Just very quickly, I can recur the same comment across UK and Europe. That obviously may change with the introduction of the latest LLMs and the issues over tokens, but we've yet to see it.
How does the company reconcile its time and materials T&M revenue mix with its increasing focus on outcome-based contracts? And what are the specific pricing structures and models used in these outcome-based contracts, which currently constitute 6 to 7% of revenue?
As far as T&M versus fixed price and outcome-based contracts are concerned, 6 to 7% of our global revenues on a run rate basis today are coming from outcome-based contracts. There are, at an extreme, there are models where we take over a legacy modernization on a significant risk basis, where only part of the revenue that should come to us for the effort is assigned to us, but the profits post-program success, legacy mod using our Forgex and our Neuron operating system are super normal. The second model that we use is a subscription model that we use for the Coforge mod squads, which are our hybrid agent human pods. These are monthly subscription-based models, and we allow clients a flex across FDE, choosing the FDEs, choosing the agents from the 100 plus, the 130 odd agents that we have. And the third one that we look at again are different flavors of outcome-based, but some of them are tied to technology options and others are tied to business also options.
Given the robust EBIT margin of 16%, is the company considering sacrificing some margin to achieve even higher growth? Or is margin expansion expected to continue organically?
And as far as the trade-off between EBIT at 16% and growth is concerned, we believe very strongly that solution-led selling does not warrant price discounting to accelerate growth. As I suspect you heard us say 2 or 3 times during our collective commentary across the three of us, we feel very assured that we will set the benchmark for revenue growth for the industry for the 3rd year running. And at the same time, we are equally keen to be the highest, if not one of the highest. The aspiration will be to be the highest margin mid-cap as well. We think exceptional growth will still come despite staying at a 16% odd EBIT level that we've already achieved. Incidentally, I just want you to know that 16% EBIT is a consolidated EBIT number. Standalone Coforge for the quarter came in at 16.7% EBIT.
Given that Q1 has historically been a seasonally weak quarter for free cash flow, can the strong cash flow this quarter be expected to continue, eliminating the previous seasonality?
We had taken this feedback from all the investors and had structurally made that change of improving the free cash flow quarter on quarter. It was H1, which used to be almost near zero for us for many, many years. It has taken us 2 to 3 years to come to a point where we stand today, and we feel very confident that we'll only build onto this in years to come.
What are the specific terms of the 3-year loan at a 4.6% yield? And are there any restrictions on cash or other special conditions?
There is no cash that is restricted. The reason why it is only 30 pips higher from the SOFR, which is a 3-year SOFR standing today. We signed this deal at a fixed rate of next 3 years. We didn't want to bet on that, and that's why we signed a 3-year fixed term loan, and that's why it stands at 4.6%. The post-tax impact is actually cost in the P&L is 2.99 because this loan is sitting in India. We get 35% tax benefit on that. There are no such fancy terms which will restrict any action that the company might have to take in future.
Will the company reduce its Forex hedges now that the loan is in India, providing a natural hedge?
And I've already said that we're not hedging more. We have a natural hedge and we'll fund it through that.
Can the company reconcile the different goodwill numbers reported in rupee terms in the presentation versus the notes to account and BSE filing?
Dipesh, the goodwill, the result sheet has the notes and the notes has the correct goodwill, and that is what has been recognized in the balance sheet. Yeah, so 120890 is the goodwill.
What differentiated delivery and go-to-market models allow Coforge to achieve better results and increasing deal wins compared to its peers, who are seeing less accelerated discretionary spend?
Sandeep, our results have been far superior to the industry for the last 9 years. You heard us talk at different points in time around our domain depth, the fact that we choose to work in very select verticals. You contrast data, cloud, and AI-led engineering being 86% of our revenue versus some of the larger peers in the industry. You are looking at a materially different firm from a capability, from an execution intensity, from a domain orientation, and from, I suspect, and I posit, a hunger around the go-to-market cadence than some of our peers.
I think, especially in this world, context, which is your functional focus and specialize, it's also the institutional knowledge that we have of our customers, which adds to that context. And that has come about because of the long tenure we have with our customers. And then second thing, which was just to reiterate what Sudhir said, execution.
When are wage hikes expected for the company's employees this year?
As far as the next two questions are concerned, as far as wage hikes are concerned, for a very select group, and I mean a highly select group, wage hikes did go into effect in Q1. But for the broader organization, we anticipate no wage hikes at least till the 1st of January of next year. And that too isn't certain. And if we do at a broad level, it's not going to be before Q4.
What is the current demand backdrop for the industry, considering deflationary trends versus the revival of discretionary spending and other tailwinds? And what is the growth outlook across all industry verticals and geographies?
Every one of the industry verticals, banking, insurance, travel, healthcare and high-tech, of course, are on steroids. UK public sector under John is on steroids. Right now, every engine is firing. But given the fact that every engine is firing, we feel really good that irrespective of what happens, this is going to be yet another industry-leading growth year for us. I think the industry has deflationary trends linked to efficiency, but the industry also has significant tailwinds around legacy modernization, around creating AI-ready data foundations, around creating cloud infrastructure ready for the AI that is scalable, that will allow for compute at scale, that will allow for model hosting, that will allow for MLOps. The industry also has significant tailwinds on account of everything that's happening on the security side. So yes, efficiency-related deflation is a reality, but the opportunities around legacy mod, data AI-ready foundations, cloud scalability, MLOps, model hosting, security are real here now. custom agentic solutions, creating agent harnesses, managing that agentic ecosystem that is going to get formed, helping with model development and deployment. If we put our heads down and we focus on the opportunities are many, but they need a very hard pivot. For us, the tailwinds are very strong. For us, the growth right now is very strong. As I said, had we not culled the business that we said we are culling, we would have grown 5.2% CC quarter on quarter.
Given the $15 million ramp down in the India government business in Q1 from a $50 million run rate last year, will the remaining $35 million ramp down occur uniformly over the next 3 quarters?
Aditya, it's part of the base now. So there's no incremental impact that will come from a growth standpoint.